Hello everyone, this is Marshall Gittler, Head of Investment Research here at FXPRIMUS, bringing my European opening market comment for Wednesday, September 21st. There are no major European indicators expected today, so instead I'm just going to discuss the Bank of Japan's decision overnight. They really must stay up late at night trying to think of new ways to fiddle with the economy. First, they introduced quantitative and qualitative monetary easing, or QQE. When that didn't work, they introduced QQE with negative interest rates. Now that they see that negative interest rates actually harm the economy, they've switched to QQE with yield curve control. There are two major components of this new program. The first is yield curve control. At the short end of the yield curve, the Bank of Japan has kept the benchmark rate for part of bank reserves unchanged at minus 0.1%. But at the long end, this is the new part, at the long end they'll target the 10-year Japanese government bond, the JGB yield, at around current levels, which are 0%. So they'll buy bonds if yields start to move up, or they'll lend money for up to 10 years at a fixed interest rate if yields start to move much lower. I've never heard of anything like that before. Their longest operations up to now were 1 year. The ECB's long-term refinancing operations are something like 3 years. Now, keeping the 10-year yield at 0% has two effects. First off, they're guaranteeing that if the banks or anyone else buy 10-year bonds at this level, they won't lose money. Secondly, by preventing 10-year yields from going below zero, the yields of longer-term bonds should stay positive. That'll help the profitability of insurance companies and pension funds, which need long-term assets to match their long-term liabilities. In any case, cutting the interest rate on bank reserves further into negative territory, one of the things they could have done, would have hurt bank profits. So this is better than the alternative as far as the banks are concerned. The second part of the new program is even more radical in my view. Before, they were pledging to get inflation back up to 2% by a certain time. They never met that target, so they just kept pushing the certain time out further and further. Now they've scrapped the target date entirely, and instead they pledged to keep expanding the monetary base until inflation is stable above the 2% target. In other words, they've committed to keeping policy loose until they overshoot their inflation target sustainably. This is the only central bank in the world that I know of that's done this. They also said they'll cut interest rates further if necessary. The moves seem aimed at reducing the harmful side effects from the negative rate policy, which was hurting bank profitability. And by hurting bank profitability, could actually make them less willing to lend. Now, what are the impacts of the moves? Japanese stocks rose as banks and insurers are seen as benefiting from the move. That's the white line in this graph. Dollar yen, the yellow line, moved up almost in lockstep with the stock market. That seems to have been the path by which the Bank of Japan's move affected the currency market. But as you can see, once the Tokyo stock market closed, the yen began strengthening again. That's because these moves probably won't directly impact the currency so much. It's an indirect impact. By making banks and insurance companies more profitable, they won't need to hedge their overseas investments so much, and they may be willing to take more risks and buy more overseas assets. But on the other hand, by making Japanese bonds more attractive, the Bank of Japan could be discouraging these institutions from investing so much abroad. So the impact on the currency isn't that clear. Meanwhile, as for the bond market, the JGB yield curve steepened somewhat as 10-year yields, which had been below zero, moved up to around zero. Rates at the longer end moved up as well, which may have been as much the BOJ's intention as anything else. All told, I believe that the Bank of Japan's pledge to keep policy loose not only until they achieve their inflation target, but until they sustainably overshoot their target, is the most radical thing I've heard from a central bank. I think in the long term, that should work to weaken the yen. But in the short term, I'd say a lot depends on what the Fed decides tonight. I've already put out a video on tonight's FOMC decision. Please take a look at that. And for an update on the U.S. indicators coming out today and tonight's Reserve Bank of New Zealand decision, please watch my North American opening market comment later today. This is Marshall Gittler, Head of Investment Research at FXPRIMUS. Get more market insights on our education pages and turn your trading ideas into action with FXPRIMUS, the safest place to trade.